Hello traders, in today's video we will discuss something which I would define as foundations of financial market and foundation of every speculative trading, and this is nothing more nothing less but volatility. Because well, if you would actually look it more deeper at every market and at every trading possibility, you will see that your money making opportunity lies with market volatility. So if you want to understand markets, you have to understand market volatility and how it works into your advantage. So let's roll on. Now let's start with the obvious one. What is actually volatility? Let's start with layman's definition, and I would simply say that volatility is simply price movement of every financial market or security that you could name. The trick here is to objectively define this price movement. So what we are doing? We are usually taking specific time period, whether it's month, week, day, 4 hours, 2 hours, 1 hour, 30 minutes, whatever, and look how at that specific time period have moved our prices. Namely, what's the opening price, what's the highest price, what's the lowest price, what's the closing price. And then if we are simply calculating these past movements, we have understanding how these prices move. And this is our volatility. Really simple. And actually, there are two major definitions which are used to measure volatility. One is historical volatility, which is something very similar to what I just described, or in simple words, we simply take past data and we see how market prices fluctuate. Namely, what's the pattern there? What are the difference between previous price movements, whether they're stable, whether they're rising, whether they're falling, and what we could deduct from that. Second measurement is implied volatility. Now, here I would say things go slightly more trickier, because implied volatility is measured based on options, and in simple words I would say this is something of a market's perception of future volatility. Now, formula here is slightly complicated if you are not familiar with options, because it derives from options formulas, and if you don't know options, I would have real difficulty to tell you how exactly it works. So probably this wouldn't be topic for this video, because implied volatility is rather specific thing and I need to show you specific examples for you to understand it. So let's just skip it for the day and let's just conclude implied volatility as measurement of future volatility based on options of underlying security. I know this also sounds rather complicated, but let's leave it there. So let's move on and let's start look at historical volatility in more detail. So if we want to talk about volatility for trading, we have to open markets and see that from more practical perspective, because otherwise you will very quickly lose my idea. So let's look at this S&P 500 chart into 30 minutes, because it will be rather good gauge of how volatility works. So we have our chart, we have our average true range, and from here we see that simply our Japanese candlestick charts shows us larger price movements in 30 minutes and narrower price movements, and this is the same example of volatility. Here we have high volatility, here we have low volatility. Simple as that. And actually, as a trader, you have to use it in the two ways. Firstly, as a trading opportunity, because volatility gives us trading opportunity, and secondly, as a risk management tool, because more market moves, more cautious we have to be, and vice versa. The less volatility we have, more risk we can afford. So these are obviously the two reasons why we have to understand volatility pretty well. But let's start with the trading strategies. So if you want to trade with volatility, the most obvious example is to trade with price breakouts. And here we have two options: whether price could break out of specific time period. For instance, we could have highest price of last week. For instance, here we have 11th of October, and in this period this was the highest price. So if we would see prices break out on upside from this range, we have price breakout, or simply price breakout from support or resistance lines. So here we have something which we could loosely define as a support line, and this would be something close as a resistance line. So if prices would break out of these levels, we will have volatility breakout and we could start to make trade in this direction. So this is one way how to look at it. To do this correctly, we need average true range. Now, if you have looked previous my videos, you would see that I make huge emphasis on average true range, because this is the best free indicator for you, and it could completely change your trading approach because it gives us assessment of market risk. So average true range simply shows what are the average volatility or price movement of specific markets. So here we could see that it's only 8 because now we have early hours in American trading session, and there is no price movements yet, so this is unusually low for trading day, but trading day hasn't started yet. So this is why it's so low, but you could see the patterns here. Once there is night, trading volatility is low, and then when trading day started, it goes higher. Average true range shows it spectacularly, and this is why you should use it as gauge for risk management. You could use it for stop losses, and you could use it for engagement of market movements. Excellent tool. So let's dive this up together. So we have two ways how to look at volatility. Firstly, as I told you, volatility is measurement for price entries, and you have to see how volatile market is. If market is moving in short consolidation line, and if it's narrowing its trading range as we have now, we could see from average true range that market movements are lower, hence volatility is lower, and it moves in narrow range. Here we have support line, here we have resistance line, so it moves tightly, and there is good chance that once trading session starts, it would move in either direction. So here we could see volatility as an entry point, and to gauge whether the price movement will break out and how it will break out. This is excellent way how to see market volatility as an entry for traders, but at the same time it works as a risk management tool as well, because here you could use average true range multiplied by 3. So it means if our markets are trading here, we have to look at either at upwards or downward price where we could put our stop loss according to average true range and go in specific direction. For instance, if we believe that markets will break up higher, we will put average true range somewhere here and see if markets will go at our direction. We have good chance to make money, because here it worked in both ways. Volatility with average true range showed how large our stop losses should be, and volatility showed with price breakouts and price consolidation and at what point price will break out, and it served us as an entry tool as well. So both risk management and exit tool and price breakout as an entry tool. So volatility works both ways, and this is why I told you it is foundation of trading, because everything in trading more or less relates to volatility. Trade entries, market volatility, and risk management, it's all tied together, and everything else is based on this volatility. So it's extremely important for you to understand how it works and how to use it, because it's a double-edged sword. Volatility could make you a fortune, or it could ruin your trading account. It's not bad or good, but it's simply dependent on your ability to execute it correctly. So use it wisely, and if you want to use it in the best way possible, I suggest you to follow my Telegram channel, because there you will be seeing a lot of these examples, not only in S&P 500 at 30-minute chart, but you will see major cryptocurrencies, forex, stock indices, commodities with different time frames, and you will see how to use volatility as a professional, how I use average true range to make my stop loss levels and adjust my risk, how I use moving averages and price breakouts for trade entries, and combine this into profitable strategies. And in addition to that, you will get free trading signals as well. So let's conclude this video. Volatility is the tool that makes or breaks markets. If volatility is high, markets are wild and you have plenty of trading opportunities. If there is no volatility, you have no trading opportunities. And volatility could be divided into two, I would say, definitions. One is historical volatility, which is obviously historical price movements, and second one is implied volatility. And implied volatility is slightly more complicated tool, and it's more used by options traders and professional market analysts. But the ways how to use it as a trader is simple. Use price breakouts and price consolidations to see how markets are moving. For instance, you could see support and resistance lines or ranging markets, and if prices break out of these corridors, you have volatility based breakout opportunity once you can enter your trade. And secondly, use average true range as a risk management tool and to see how large your stop loss should be. In other words, if volatility is higher and markets are wilder, your stop loss should be larger and position size smaller. And once your volatility reduces, you could narrow your stop loss and increase your position size. That's how it works in combination with different trading strategies, and you have to absolutely understand and master this, because this is the same as it is with risk management. If you don't have understanding of volatility, you really don't have understanding of trading. So learn it, because it might be quite boring topic, but it's extremely important topic to understand it. So thanks for watching this video. Join my Telegram channel, subscribe me, watch my videos, and see you later.